Welcome everybody to the May Pairs Trading Mentorship. Sorry, give me the link to log in here. This is day one. Today we're going to be covering a couple different things. So the way that this works, we have 4 days that we meet this week. We meet today, tomorrow, Wednesday, and Thursday. We're going to meet at 5 p.m. Eastern each day, and you can use the exact same link to log in each day that you used today. All right, I'll be recording each session, and each session I'll be trying to get it emailed out to you the same day. So hopefully an hour or two after the mentorship is over, I'll get it out to you. So if you ever miss a session, you should be able to catch up and be on the same page as everybody else if you can watch the recording. The other thing is, because we're in GoToMeeting, you can ask questions whenever you want. All you got to do is unmute yourself. You have control over your mute button. You can unmute yourself. Now, I can, if there's something happening in the background or a lot of background noises or something, or you don't realize you're unmuted, I'll mute you. But feel free to unmute yourself and ask questions if you have a mic. Or you can, if you don't want to talk, you can have it in the chat box. Now, just a general disclaimer, like everything else, I'm not an RIA, so I'm not a registered investment advisor. Cannot tell you that you should or shouldn't trade any one way or the other, but what I can do is I can tell you this is how I trade, and I can tell you things like this is what I would do if it was me, and I can give you general advice. So I can say this is what I tell everybody. Robert, just so you know, I just muted you because you had background noise coming through. Alrighty? If you wanted me to unmute you, just say something in the chat. So today, what we're going to be talking about is a couple different things. First, kind of the fundamentals of what pairs are, what we're trying to achieve with pairs trading. We're going to talk a little bit about setting up your price charts, getting them all together, what the spread difference and the spread ratio are, the basis line. We're going to talk about portfolio margin, notional value, ratios that you trade one contract to the other, all that good stuff. So that being said, let's go ahead and get started. Just so you know, each session's about 45 minutes long, roughly, depending on questions and things. All right, so with pairs, when we are trading a pairs trade, we are not trading a directional trade. What we're trying to do is maintain market neutrality. Now, what do I mean by that? Well, with market neutrality, it means we're not really looking to say this market should go up, or we're not looking to say this market should go down. What we're doing is we're going to have two legs of each trade. Now, a leg, each pairs trade has two trades on it, okay? Trade 1 and trade 2. Each trade is called one leg of the trade, all right, or of the position. So let's say we want to maintain a neutral position. What we have to do is we'll take two correlated markets, two positively correlated markets, and we will look to place a long trade in one and a short trade in another. So for example, we'll say gold and silver. Those are two correlated markets. So we could be long gold and short silver. What the goal of this is it's to remain neutral. So we're not saying gold and silver markets should go up or should go down because they move together. We're looking to be hedged. So if gold moves like this and silver moves like this, we're looking for them to stay roughly equal and be hedged, all right? So neutral. Doesn't matter if the market goes way up or way down. One leg is going to make a lot of money. One leg is going to lose a lot of money. Okay, I've had trades where you're up $30,000, $40,000 on one leg and down $30,000, $40,000 another leg, and really your net difference is just a couple $100. All right? So don't pay attention to that. The other thing to keep in mind with pairs trading, you hear me talking all the time about reward risk and how reward risk is so important and how we want to have a 2-to-1 reward risk ratio and things. We don't necessarily need that in pairs trading, so you got to think about it differently than you do a directional trade. All right, you know how I always say you have to have a balance between reward risk and percent win? Well, with pairs, what we're doing is we're doing that percent win. Okay, we're trying to get our win rate way, way up, and our reward risk will be around a 1-to-1 reward risk. Okay, so we're making about as much as we on our winning trades as we lose in our losing trades. It's a little bit better, slightly better, but our win rate should be 80% or higher. So the majority of the trades we're placing should be making money. Now, we're not looking to, with pairs, the other thing is, don't come in thinking you're going to do what you do with a directional trade and you're going to place one trade and the market's going to move $1,000 on that day and you can be making $1,000, $2,000 a contract per day. It doesn't work that way, right? This is more about hitting those singles and doubles over and over and over again. So all about the consistency. And with pairs, it's a good way, in my opinion, to have an income generating strategy. One where it's very reliable and consistently giving you the same types of returns. All right? So keep that in mind. Now with pairs, because we are both long and short each market, so let's say this is gold and this is silver, what we're looking to happen is a lot of times it's called volatility arbitrage or reversion to the mean or mean reversion strategy. What we're looking for is if they normally move like this and they normally move together, let's say one day gold goes like that and silver goes like that. Okay? So now where they normally are only trading this far apart, for some reason they got out of whack and now they're trading this far apart. So what we're trying to do is mean reversion. We want them to get back to how they normally trade. So in this case we would be selling gold, buying silver. What we're looking to happen is for these two kind of get back to how they average, how they typically trade. Okay, and now what we would have done, now it's normally not going to look quite like that. It'd be more like they continue to climb, for example, except silver starts to accelerate a lot faster and they get back to how they are. So you would have this much of a loss in gold, but you would have this much of a gain in silver, and your net is the difference. Does that make sense? So it doesn't matter that the market goes way up or that the market goes way down. What we're looking for them to do is get back to how they typically trade. Get back to the normal. All right? Now, because we're trading it this way, there's not a specific time that we're entering in the trades necessarily. All right? We're roughly getting in at an extreme. All right? So, for example, with a breakout trade, we're trading right after the breakout and we expect it to boom, move our direction right away. A pairs trade is not necessarily the same thing because it's not an exact science of now we're jumping in and now we expect it to run. It's, all right, we're getting way out of whack here. Time to start looking for an entry. We place our trade and then we're looking for it to move back together. But that could take a lot of time. It could continue to go apart if something happens. That's where you lose money. But again, we're not necessarily looking at an exact time of timing our entries exactly. And the reason I'm telling you all this stuff now, even though we're not going to talk about entering the trade yet, is because I want you to look at this with a different set of eyes, so to speak. All right, because if you've been in trading for a while, you know how we normally trade. This is different. All right, we're timing everything different. We're doing it differently than what we normally do. All righty. Now, with pairs, if you're on Toss, you can use the Pairs Trader. If you're on any other platform, I don't know if they have Pairs Traders, but you can, if you're not calling your broker and saying enter at X basis ratio or basis on the basis graph, then you'll just buy and sell each leg of the market. So we're not going to buy a gold-silver pair. What we're going to do is we would buy gold, sell silver, and that would be long a gold-silver pair. Okay, but you're placing two different orders in two different markets. All right, now you can talk to your broker and ask them for discounted commissions, tell them that you're trading pairs, that's why. And the other thing you want to talk to your broker about is whether or not they offer what's called portfolio margin. All right, so portfolio margin, because we're trading correlated markets and we're trading correlated pairs, the volatility is much, much lower than if we were just going long or short one of these markets at a time. So if your broker offers portfolio margin, they'll discount your margin requirements based on that volatility in the pair that you're trading, and they'll discount your commissions. All right. Now, not all brokers will do that, but a lot will. Yeah, with the TOS pairs trader, it's not designed for futures. It's designed for stock pairs, and it doesn't work except for during market hours. You are correct, Gary. Now, the other thing to keep in mind, because we're just looking for two highly correlated markets that normally trade together and then get out of whack, you can also trade, mainly I trade futures, but you can also trade equities and ETFs and trade pairs between them. Okay, just look for something highly correlated. All right. Now, any questions about what I've said so far? Pretty basic, just explaining what pairs are, explaining what notional value or what portfolio margin is. Now, you can get a little more complicated where gold and silver are a positively correlated pair, and they normally move together. We could also look at negatively correlated pairs. So we could look at something like the euro and the dollar index. So what does that look like? Because they're negatively correlated, if this is the euro here, and this is the dollar index here, and the euro, as that goes like this, the dollar index is going to go like this and move the exact opposite. All right. So in order to maintain a market neutral position, if you're trading a pair in a negatively correlated market, then you need to go long both legs or short both legs. All right. Does that make sense? That way, if the market starts ripping one way or the other, let's say the market starts jumping, you'll make money on that leg and you'll lose money on this leg because they're negatively correlated. So keep that in mind if you're trading negatively correlated pairs. All right, so just a quick recap. Essentially, all we're looking for is for markets that normally move together to get out of whack. When that happens, then we place our pair and we look for them to get back together, and we make the difference. All right? Pretty simple stuff, but highly effective. And again, the advantages to doing this, market neutral, so we don't have to pick a direction that the market's going to move necessarily, and lower volatility, and increased duration, because we can leave it in there for a longer amount of time. Now, the other thing that a lot of people ask me is, how do I know when to enter, which we'll cover later, but also, where does my stop loss go? Because you always hear me talking about placing stops with pairs. So when I'm trading just a futures contract long or short and trading directional plays, I always have a stop loss. When I'm trading pairs, I don't have a stop loss necessarily. What I look for is, as long as my average, or as long as the ratio is below about $500 a pair, I'll think I'm in good shape. If it starts losing more than about $500 a pair, I'll look to close it. But because we're not market neutral, you can't place a stop unless you're calling your broker and saying you want to place it somewhere on the basis graph. All right, which we'll talk about that here in just a second. So there are a couple things we're going to look at. When you look at this chart here, you can see this is soybeans and soybean meal on a 60-minute price chart plotted at the same time. You can see they typically move together pretty good. We have a few different indicators that are applied on here as well, and these are all free indicators. All right. So the first thing we have is the spread difference. All right, so the spread difference, this is, all this is number one, it's market number one. So let's say gold and silver again. So if gold, this is spread difference. Gold minus silver gives us the difference. Alrighty, so all you do for that is you would take the price of gold minus the price of silver. Okay, so in this case, gold's trading at 1226.2, silver is trading at 16.235. Therefore, your spread difference would be around $1213.57. Okay, around $1,213. That's, I'm saying that number because that's what the gold silver spread difference is on August gold and July silver. All right, now the spread ratio. Spread ratio is just gold divided by silver. Okay? Your spread ratio is often, or also called the basis graph sometimes. Alrighty? It's not a difference based on percentages. It's just one minus the other. For spread difference, spread ratio is just gold divided by silver. Okay, so for example, right now, spread ratio on August gold versus July silver is 75.75. Okay, so we go down here and we look at soybean meal, or excuse me, soybeans versus soybean meal. The spread ratio, the price of soybeans divided by the price of soybean meal is 3.0769. The difference is 650.7. They move similarly. So they move similarly, but they don't move the same. Okay? Make sense? Then the last thing down here is just the correlations. How correlated these markets are. You can see they're pretty highly correlated. When do we get trade opportunities? When those correlations fall through the floor. Okay? When normally they trade together. When they get way out of whack, there's normally a potential opportunity. All right? Any questions about spread difference and spread ratio? You'll learn why we use those here in just a minute. Well, all right. Now, when you're going to set this up in TradeStation, all right, if you have a blank chart, you're going to right-click on the chart. You'll have one market on there always. Okay? You'll have one market on the chart, obviously, and then you're going to go down, you're going to right-click on it, and you're going to go Insert Symbol. You'll insert the symbol and click Plot. When you plot it, you're going to go over to this box will pop up. You want to format that symbol. You'll go to Scaling. And the axis that you scale it on, you want to set it to subgraph 1. So it's on the same graph as your other one. Okay? Then you click All right. And that'll put both of those up there. And then to insert the indicators, you just right-click, Insert Analysis Technique, and the indicators are going to be on there. Spread difference, spread ratio. Okay? Now, on TOS, I can show you how to do it on TradeStation and TOS. I don't have any other platforms. On TOS, for example, let's say we wanted to look at the BUB spread. That's 30-year bonds versus Ultra Bond. So we go ZB minus /UB. Okay, so if we're doing one minus the other, and we plot that, what are we looking at now? If it's one minus the other. You guys remember? Just told you. This is the spread difference. You got it. Now, if we wanted to plot both of them on the same chart, we'd do ZB as number 1, and then we would go studies, quick study, compare with, select a symbol. We'll go UB. There you go. Now I have ZB versus UB. Okay? Makes sense? And then the ratio, I believe there is a quick study for inserting spread ratio as well. Maybe there's not. I'll have to look. There we go. It's pair ratio. Let's see. I thought there was one here. There's pair ratio and pair correlation. Okay. So we insert pair ratio, and that'll be down at the bottom. Okay. So honestly, it's even easier, in my opinion, on TOS to plot everything than it is on TradeStation. You'll have to ask your broker if you're on a different platform than TradeStation or TOS, just because I don't have every platform and can't tell you how to do it on every platform. Alrighty. So any questions so far? We talked about what are pairs trading, what are we looking to do with them, what's the spread ratio, spread difference, the basis graph. We talked about the correlation, how they show, etc. How do you keep the spread difference while still showing both legs in TOS? You'll have to add an extra chart in TOS. You'd have to add an extra chart. So you go here and you go to this. We'd add an extra chart and you'd plot the ratio on one of them, or the difference on one of them. I'll send you notes that Andres took in the last mentorship that work really, really well. He took some really good notes on pairs trading that you guys can use. All right?
Tom, I have a question.
Yeah, go for it.
I noticed you changed one parameter in the correlation. The length is, at least on TradeStation, the length is 50 instead of, I believe, 14, which was the default value. Is that correct?
Yep. I just changed it to get a longer-term view of how they're correlated instead of short-term. Because this is just looking at the previous 50 bars to determine the correlation. Before, I was only looking at the previous 14 bars to determine correlation.
Okay. Well, and one other question. I see you have it in a 60-minute time length. Is that the same time parameter that you always look at pairs in, or do you vary that?
Yeah, I normally look at 60s and dailies, but 99% of the time I'm looking at 60s. Now, if you want to go very short term and you want to do like intraday scalps and stuff, you can go down to something like a 30-minute or a 15-minute or a 5-minute and look at for your spreads to get way out of whack intraday. Just keep in mind, if you get in at the start of a big move, so for example, let's look at GCQ17 and look at SAN17. You see how wide the spread has gotten recently? If you're trading intraday pairs and you do that right here, and that just keeps on moving against you, and this spread difference here is several $1,000s per pair. Okay. So just keep that in mind. But yeah, 90% of the time I'm looking at 60-minute price charts. All right, now when you're trading pairs, you don't want to just trade one-to-one ratios necessarily. Most things you can do one-to-one, but what you want to do is we want to base our pair off of the notional value. Okay? I'm not sure, Peter. Ask Infinity. I'm sure they'll be able to tell you. So with notional value, all we're looking to do is we're looking at the cash value of that product, all right? So, for example, crude oil contract is 1,000 barrels of crude, right? So all you do is you multiply 1,000 times the price, and that gives you your notional value. So if crude was trading at $50.24, that would be $50,240 notional value. If Brent crude is trading at $55.59, then the notional value would be $55,590. Okay? So if we're looking to calculate the ratio that we trade one to the other, and if you really want to get specific, you drill down. So if normally for me, if they're roughly the same, within 10, 15,000 of each other, I'll look at trading one-to-one. But for example, if you look at something like the Russell versus EMD or platinum versus silver, all right, then there's a big difference there. So the Russell, for example, trades at $60,000 or $70,000 notional value. EMD is trading at $170,000 notional value. So we'd want to do a 2-to-1 ratio. We do 2 Russell for every 1 EMD. All right, all you got to do to figure it out, I'll send everybody this Excel sheet, but you'll put the ratio, the notional value of contract 1, notional value of contract 2, that'll give you the ratio, and then it will convert it to a fraction for you. Okay? Does that make sense? So when you're trading, again, you're basing your position sizing off of the notional value of the contracts. It's the cash value of the contracts. So if you're looking at a pair, looking at trading a pair of an equity, so let's say you have 2 equities you're looking at trading. One's trading at $10, one's trading at $20. Then you'll do 2 of the $20 one, or of the $10 one for every 1 of the $20 one to keep your notional value the same. Any questions about that? Now these are just some of the pairs we can trade: crude versus Brent crude, crude RBOB, crude heat oil, Brent crude RBOB, Brent crude heat oil. These are not all of the pairs by any means, but again, I'll send this out to everybody so you guys can see. These are just like some of the correlations I put in there when I checked at the time. Don, do you have a question?
Yeah, if the ratio comes out 0.75, are you going to do 2 or 1?
You could do, I'll do 1-to-1, but really you'd be looking at a 3-to-4 ratio. So you trade 4 of one for every 3 of the other. But you have to have a large enough account size to do that. That's why I say if it's close, you'll do 1-to-1 normally. Right? And if it's way out of whack like that and you can't, if it's throwing you for a loop and you're going, I don't know what I should be doing, then just leave it alone. Pass on it. Okay? Now, you can get more complicated if you want, and you can start looking at what's the notional value, and then you also have to multiply it by, you take the notional value and you multiply it by the volatility, like the average true range. So you take how much that market actually moves in a day. So for example, silver and gold, there's a pretty big difference there. You're talking 35,000. However, silver is a much more volatile market than gold is. So I'll still trade a 1-to-1 ratio. Okay? But for just generally speaking, stick with 1-to-1 or 2-to-1. And don't worry about the others unless you're trading a much larger account. And if you are, then shoot me an email and I can help you figure out when exactly and where exactly you want to be doing it, your ratios. Alrighty. What else was I saying here? Like I said, I'll send everybody this Excel sheet so you can start putting together your notional values. Make sure your correlations, you want to be pretty highly correlated. I mean, they should be up in the 60s, 70s majority of the time. You can see all these correlations are all pretty high. Gold, silver is pretty, or feeder cattle, live cattle is pretty low. Gold, silver is also pretty low, but most things are really high. Now, even though this is how you're going to find your ratio, typically, if you're trading any of the interest rates, okay, you're trading like the BUB spread or the FIGHT spread or the FIT spread, what you'll do is you're going to go to this website, cmegroup.com, and here you go, I'll send it to everybody in chat so you all have it. So save this on your computer somewhere. All right, and this will tell you the exact ratio that you use for each of the different intercommodity treasury and swap spreads. So for example, we look here, then we'll go to June 2017. So if we're trading June 2017 contracts, this is what it comes out as. All right, so if we're trading the BUB spread, which is 30-year bond versus ultra bond, it's a 1-to-1 ratio. Okay, trading the NOB, 10-year versus 30-year, 3-to-1. 3 10-year note for every 1 30-year. Okay, the FOB, 5-year versus 30-year, 4-to-1. All right. Your FIT, 5-year versus 10-year, 5-to-3 ratio. So if you're trading any of your interest rate spreads, you're going to want to just go to that website, cmegroup.com, look up the intercommodity treasury and swap spreads, and they'll tell you the current ratios for the contract months. Alrighty. Any questions about that? A lot of times with pairs, all right, you're getting I said you're reducing volatility. The volatility reduction is 60, 70, 80%. Okay, so a market that normally might have $1,000 day, you're now having a $200 day on average. Okay? Does that make sense to everybody? So you're decreasing the volatility quite drastically. All right, let's get rid of that. Now, as I mentioned earlier, with pairs, you need to think about them in a different way. And we're not looking to hit the home run on anything, really. Right? Every once in a while, you'll get a pair that makes $500,000, $2,000 on the pair. But generally speaking, me personally, for example, I normally am going for anywhere from $150 to about $500 on each pair. And like I said, it's singles and doubles over and over and over again. And one of the things I've been working on here is just growing I took a $17,000 account. I've been working on growing it just so I can show you guys what you can do with pairs, all right, and the consistency that we're looking at and everything. This is what it's looked like here recently, and this is since I started tracking it for this reason, for this purpose. All right, so again, it's just small gains over and over and over again. You can see here it's like $80 gain, 162, 182, 192, 192, 177, 192. This is just one pair at a time. The biggest gain I had on here is 442 on one pair. Okay, but you can see how consistent it is. It's very steadily up, up, up. I've had 3 losers, I think. 3 losers out of almost 30 trades. So not a bad percent win. Like I mentioned before, we're not looking for a huge reward risk or anything like that, or we're looking for consistency. All right, and it's that balance between reward risk and percent win. Now, when you're looking at your correlations, make sure you're looking at, I touched on this just a second, make sure you're looking at the length, increase the length so you're looking at a little bit more time, because you want to know over time how correlated are they. They should be pretty highly correlated. Some things, for example, gold, silver, they've been out of whack here recently. Silver's been taking a nosedive, gold not nearly as much. They're still out of whack, and that's why this has happened, but normally they'll stay pretty correlated, and you'll be able to see how they work. And I'll explain that all starting tomorrow. We actually start talking about when do we want to be placing trades. Now, some of the jargon here in general, let's say if I say go long, I'm going long a pair. Okay, so let's say we're looking at, we'll do it once again, gold versus silver. I'm saying I'm going long the gold-silver pair. That means I am going long gold and short silver. All right, the easiest way to remember which one you're talking about if you're saying going long a pair, short the pair. Long, if you're going long the pair, that means you're going long the first market on that pair. So if it's gold versus silver and I'm long the pair, then I'm long gold and short silver. If I'm short the pair, then that means I'd be short gold and long silver. All right? So keep that in mind as well. Let's see. That's the main thing I wanted to cover today. I feel like I'm forgetting something. Oh yeah, calendar spreads. So you can also trade calendar spreads. And the way a calendar spread works, and again, it's volatility arbitrage. Sometimes they'll get out of whack, sometimes they won't. But you can trade a front month versus the back month. So we could trade, for example, GCQ versus GCM. Let's trade the June contract versus the August contract of gold. And you can, they are typically very, very highly correlated. Sometimes they'll get out of whack and you can make a difference there. Also, you can hedge yourself. All right. So if you're in a trade overnight and you're scared that it's going to be running without you, but you don't want to place a stop loss because you think you're in a good position, you can use a calendar spread to hedge. So you could buy the back month. Okay? Or sell the back month, whichever the opposite is of your original entry. I personally don't trade calendar spreads very often. Alrighty. Let's see. I think I touched on everything I wanted to talk about today. So tomorrow we're going to start talking about timing trades, when you're getting in and everything. Same thing we'll talk about counter trend and trend trading, and waiting, having a directional bias with the pairs all over the next 2 days. And then Thursday, what I'm going to do is I took screenshots of what the market looked like for every pairs trade I've done over the past couple of months. So I will show you what exactly the screen looked like so you can see kind of what the markets look like when you're going into a good potential setup. All right, so Thursday what we're going to do is it's kind of like tying everything together. We're going to take everything you learned and I'm going to start showing you kind of the trades that I've actually been placing and how they worked. All right, so you can kind of see what it looked like on the right-hand side of the chart as it was developing. Okay, so the fun stuff starts tomorrow and the day after, and then later on. So, yeah, Kathy, I absolutely will. I think that's one of the most beneficial things is so you guys can actually see what did Thomas see. I'd literally take it within a second or two of placing the orders, the buy and sell order, to get into the spread or the pair. Alrighty. Can you set up a radar screen? I don't know of a way to set up a radar screen. I'm not that talented with TradeStation. I am sure there's some way you could do it. I'm working on an indicator that we can use for spreads, or for pairs trading, but that's nowhere near done. And that will probably have a radar screen that goes with that. Alrighty. Any other questions? Like I said, each session is about 45 minutes long. We're at 5:42 here. Go ahead, Roger.
My gold silver chart doesn't look like yours.
Yeah. So go up to the very top of your gold silver chart. Decrease your bar spacing as much as you possibly can. That'll make it look almost the same. Did that work? It's like, for example, you look at this right here, how it is right now, and then if I go zoom in really close, it looks totally different.
No, yours, oh, I see. Okay.
So if I go and I go all the way back to compressed completely, it shows it a lot better. What this is doing is, all TradeStation is doing is it's plotting it from the left-hand side of the chart. How have they moved if they were both in the same chart? So percentage difference they're moving. So in this case, from when we were starting together back here, what they've done here recently, silver has tanked a lot more than gold has. But if we go up and we look, how have they moved since right here? At this point, they've actually moved pretty closely together. They've been pretty tightly correlated like they normally are. Make sense?
Which button did you push?
You see how you can compress or increase or decrease bar spacing?
I see. Okay. Thank you.
You're welcome. How do you actually enter a pairs trade on TradeStation? You buy. So if I wanted to get into gold silver here, if I wanted to sell the pair, which is what we were doing earlier this morning, we made some money doing that. We would sell gold. We would sell GCQ17 and we would buy SIN17. So just two separate trades. You buy one and sell the other. Yeah, I'll include the workspace here. All right. I don't have one for TOS. I don't know how to send the one on TOS, to be honest with you. But I'll send out instructions on how to set it up. Like, I'll send out very highly detailed instructions on how to set it up on TOS because Andres put it all together for me from the last mentorship. So that is it for today, everybody. I look forward to seeing you all again. Again, we'll meet tomorrow at 5 p.m. Eastern. You use the same link that you normally use to log in to get in there, and we'll take it from there. I'm looking forward to working with you. Not on TradeStation. You don't actually enter the trade as a pair unless you call them and do it over the phone, from what I'm aware. So see you guys tomorrow. Have a great evening, and until next time, happy trading.